Crypto shakes as inflation surprises. What it means for Bitcoin, Ethereum, and XRP, the numbers are in, and they rattled the financial world. The latest US inflation data came in hotter than expected, sparking immediate tremors across markets. Bitcoin, Ethereum, and XRP all dipped on the news, with traders bracing for the Federal Reserve's next move. But within hours, the story shifted, and what initially looked like a bearish signal for crypto may turn out to be the opposite. In the inflation surprise, the August Consumer Price Index, CPI, showed prices rising 0.4% month-over-month and 2.9% year-over-year, the fastest pace since January. Even more troubling, core inflation, which strips out food and energy, hit 3.1% annually, well above the Fed's 2% target. Normally, inflation like this means one thing. The Fed holds off on cutting rates. Higher rates weigh on risk assets, including crypto, since they make bonds more attractive while draining liquidity. No wonder Bitcoin and Ethereum slipped immediately after the report. But then came another number. Jobless claims surged to 263,000, the highest in almost 4 years. That showed the labor market is cooling far faster than expected, shifting the narrative instantly. Sues how crypto reacted at first. Bitcoin dropped toward $111,000, Ethereum dipped under $4,300, and XRP followed lower. Traders feared sticky inflation would keep the Fed hawkish, but as labor market weakness sank in, sentiment reversed. Bitcoin bounced back toward $112K, $113K, Ethereum reclaimed $4,300, and XRP stabilized. Altcoins like Solana and Dogecoin even outperformed, as markets bet the Fed may prioritize growth support over fighting inflation. This tug-of-war between hot inflation and weakening jobs data is why crypto reacts so sharply to macro releases. Each report swings expectations on whether liquidity will tighten or loosen, and prices move in real time. Broadening why it matters. 1. Rate cut. Tug-of-war. The Fed is stuck between inflation and a cooling job market. Which way they lean could define the next 6 months for crypto. 2. Stagflation. Fears the worst-case scenario, high inflation plus slowing growth, is back. Risk assets could struggle, but some investors see Bitcoin as a hedge if stagflation deepens. 3. Liquidity rules. Crypto thrives on liquidity. If rate cuts come, expect another leg higher. If not, expect pressure and volatility. 4. Technical zones. Traders are watching 111K as Bitcoin support and 114K as resistance. For Ethereum, 4,150, 4,350 matters. XRP's key zone sits around 0.55. On the bigger picture, this isn't just one CPI print. It asks about a financial system on a knife's edge. Inflation is sticky, but jobs are weakening. The Fed must decide whether to risk hotter inflation or a deeper slowdown. For crypto, that means every data release, CPI, payrolls, jobless claims, will shape near-term momentum. Longer term, one thing is clear. Crypto is no longer a sideshow. Institutions, exchanges, and regulators are weaving blockchain into the core of finance. Bitcoin, Ethereum, and XRP are not just speculative bets anymore. They are central to how investors navigate volatility and hedge against macro uncertainty. Closing thoughts. Today's turbulence proves crypto is fully tied to global economics. Inflation came in hot, labor came in weak, and crypto traded like any major asset class, fast, volatile, and forward-looking. The big question: does the Fed risk letting inflation run hotter or risk choking growth with high rates? Either way, crypto will be right in the storm. Every CPI release, every Fed decision, and every market swing is now part of the story of digital assets. One thing is certain: the days when crypto moved in its own bubble are over. It's now part of the global financial conversation, and each headline proves it more. Subscribe to LTL Productions for daily deep dives into crypto, finance, and the digital future. Stay ahead of the curve, because every report and every market move is rewriting the story of money in real time.